Hello and welcome to episode 313 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leaks. Damien, welcome back to the show. How are you doing?
I'm good. We've had, it was quite a milestone this week. We had our 100th episode of Midweek Markets. And I didn't really mark the occasion on the Midweek Market show itself, but that's quite a feat for a show which wasn't intended or planned like a lot of these things, a bit like the original podcast, Andy. It was something we just did because we felt it would be something people would like. And then it took on a life of its own. And here we are, 100 shows later, which is about 2 years old now. And it's still getting great feedback. And the other thing which was interesting this week, which as a personal thing on 80/20 Investor, I do lots of research pieces. And one of the research pieces I did 6 years ago, actually, was called The Perfect ISA Portfolio. And I sat down and analysed years of data in different asset classes and their performance to try and come up with a perfect asset allocation that was really one you could leave alone, that had made money in every tax year since the birth of ISAs back in 2000. And not only had it made money in every tax year, but had outperformed the FTSE 100 over the full term. So taking it up to, at that point, it was 2015 when I did the research piece. And I came up with the perfect asset allocation and told people how you could apply it. And if you want to see that piece of research, then you can subscribe to 80/20 Investor for a free trial. But every year I've gone back and looked at how it's done in the subsequent tax year. And we are now at the point where the portfolio would be 20 years old. So we're 6 years on from that original piece of research. And every tax year since that original piece of research, it's continued to outperform the FTSE 100 over the long term, but also provide a positive return in those tax years, which I think is for me, it's like you give birth to a piece of research that then is out in the wild and be tested in the real world, and it's still holding up to scrutiny, particularly in a year like the pandemic. So 2019, 2020 tax year when markets collapsed. So it was good to update that piece of research this week, which is why I'm talking about it, to see that actually at the end of last year, it looked like it might have been the first year where it failed, just as we were heading into April 2020. But what with the pandemic, it actually meant that the portfolio did well into the end of the tax year. So, and it looks like it could potentially this year, again, finish on a positive note. So I'm really pleased about that. So I just mention it in case anybody's interested. It's an evergreen portfolio. So on a personal note, it's something I'm quite proud of in that terms of research, because like I say, it's still out there being put to the test year on year and holding up to scrutiny.
No, brilliant stuff. I've been reading those pieces of research year in, year out, and it'll be interesting to see if it hits its 21st birthday and has done as well as you hope this time round. What have we got coming up on this week's pod though, Damien?
So I've got an investment piece this week that's based around bond pricing and how it works. Now, in the last month or so, you won't be able to read an investment piece or article, headline that's not talking about bond yields, bond prices. And I want to explain how bonds work, because I've been asked the question a number of times by people asking about, well, how do the mechanics work? What does this all mean? So I want to explain to people a bit more about bonds. It makes the headlines and news stories they're reading, it will help it make a bit more sense. So that's something to look forward to. I also want to do a piece on insurance. Now, I'm talking about personal insurance, things like life insurance, some hacks, some things that people should be aware of that they won't necessarily know about, and even some advisors might not be fully aware of when advising people on protection like life insurance, income protection. And the final piece is a shorter piece that's about faking it until you make it.
Okay, brilliant. So what are we going to start with? We're going to start with the investing piece and bonds and yields and how they're priced and what it all means.
Yeah, exactly that. So one of the things we're seeing in investment markets at the moment, if you've been following midweek markets, you will have heard that we're seeing bond yields rise. And the rise in bond yields, particularly in US Treasuries, is causing nervousness in not only bond markets, but in equity markets too. And certain assets have been underperforming, technology stocks being one of them. But I've had a lot of people try and understand how bonds work then. What is this rising yield phenomenon? What does it mean? And to understand why central banks, rising interest rates and inflation and bond yields all kind of come together to cause this perfect storm that we're having now, you need to understand how bond pricing works. So I want to take an opportunity today to do that so people can refer back to this episode if they want to understand how bond pricing works. So let me start off with what is a bond. So a bond is effectively a loan. So it could be a loan to a company, it can be a loan to a government, for example. So a bond that would be a loan to effectively the UK government would be called a gilt. But a corporate bond is a loan to a corporate entity. So it could be a supermarket, it could be a retailer of any other kind. So lots of companies issue bonds. Now, the way a bond works, it's easier if I give an example with round numbers. So you may, for example, loan a company £1,000 that's going to be paid back in 10 years' time. And so in 10 years' time, you will get your £1,000 back that you effectively loaned them at the start. But during that period, you may get an interest payment every year of £100. Now, I'm using fictional numbers and nice round numbers, as you've worked out, just to make things interesting. Now, if you held that bond, so when you invest in a bond, you're effectively loaning the money to that company. Your £1,000 that you've invested, you will get £100 every year thereafter, if that's how the bond is structured, because the coupon payments, those interest payments, they're called coupons, can be set at varying intervals. So we're going to just say, for example, it's going to be annually. You will receive your £100 every year, and then at the end of it, you'll get that £1,000 back as well at maturity. Now, there's some terminology that you need to understand. One of them is par value, and this determines the maturity value and the coupon amount in pounds. And usually when we talk about par value, people are thinking about the maturity amount at the end. So in my example, it was the £1,000. Now, you don't have to hold a bond until it matures. You don't have to hold it for the full term, like in my example, the 10 years. You can sell that bond on to somebody else. You can buy and sell bonds at any point during their lifespan until they mature. There's a market. That's what the bond market is. And bond funds obviously invest in bonds. So they're buying all these different bonds en masse for different companies. That affects the price of the bond, which I'm going to go on to explain in a second. So the price that somebody buys a bond off of you can be very different from the amount that you paid at outset. So another bit of terminology you might want to understand is the coupon rate. So that rate is the coupon you would get in a given year, so the amount of money that you might receive. So in my example, that was £100, and that might be divided by the face value of that bond. So that would be £1,000. So it would be called a 10% coupon. So I'm getting £100 a year. So what I want people to do now is to understand what a yield is. You'll hear yields talked about on bonds. And there's different ways of looking at the yield. A very simple way of calculating the current yield is to take the annual interest you receive and divide it down by the current price, the price that you buy at. That tells you what you would earn in a year if you held that particular bond for a year. Now, obviously, if you had it from outset and you had paid, like I said, you invested £1,000 and you got £100 in a given year, because in my example, I used a fixed coupon. It wasn't going up. It was fixed £100 every year. Then, yeah, my yield is 10%. So it's easy to calculate. But the yield can vary for different people. And that's because the price of a bond changes. And the reason the price of a bond can change is because of economics, or also because of supply and demand.
And so on that, Damien, just so I understand, I'm following this to this point. So you say the price of the bond can vary. Is that the price that you bought the bond at, or the price that other people can buy that bond varies?
Yeah, so it's a good question. It's the price that other people will pay for your bond. It's a bit like you buy a house. The price of your house will vary, but it doesn't mean anything unless you choose to sell the house.
Yeah,
so
got it. Okay.
What I want to do is to now explain to people how the price of a bond will vary and that sort of relationship with yield and interest rates. To make it easy for people, we're going to look at an example called a zero coupon bond. So if you imagine a bond where there's no annual interest payments, so what happens is that you get back the amount at the end of the 10 years. So in my example, let's imagine you got £1,000 back at the end of 10 years. Now, the reason why interest rates within an economy will matter and will impact the price of a bond is because people will look at what they're going to get in, say, 10 years, and they will sit there and think, how much is it worth me paying to be able to get that return? So let's say, for example, in 10 years' time, you're going to get £1,000 from this bond. The price you would pay today won't be £1,000. You wouldn't pay £1,000 now to get £1,000 in a 10 years' time because, well, you could put your money in a bank account and earn that money. Now, that's where the element of interest comes in. If you think of it a slightly different way, what amount would you need to put into a savings account, for example, so that in 10 years' time, based on the typical saving rates that are out there, that it would end up at £1,000? So if you worked out what that number would be, it may be, say, something like about £850, because if you put £850 in a savings account for that was giving you a pretty decent rate of return, and it worked out, I'm using sort of made up numbers, and it worked out to be worth £1,000 in 10 years. Now you can see how in a world of bonds, because I'm using a simple example where there's no coupons, you can see why the price of a bond would start to fall when interest rates within the economy start to go up. And when I say interest rates, that can be the Bank of England base rate. That can just be the general rates that are out there within the economy. Because as the economy starts to improve, don't forget, interest rates start to rise because we start to get inflation as people are all chasing after with all their extra money from their successful businesses and wage increases. They're trying to buy a limited number of resources, objects, whatever they may be. That pushes the price up. The Bank of England therefore raise interest rates to try and take that excess out and try and reduce inflation. You remember I've used the analogies before of cars and accelerations and engines and revs and all these sorts of things. Basically, all you need to understand is that to control inflation, the Bank of England will look to increase interest rates because it encourages people to save, for example, rather than start to spend their money. It would discourage people to borrow money because the rates on loans will start to go up as well if the interest rate set by the Bank of England starts to go up. So you can see that if interest rates are rising, then a bond starts to look a less attractive proposition, doesn't it? So in my example that I had, if you had a zero coupon bond and you were in 10 years going to get £1,000, you wouldn't pay £1,000 now, would you? You would end up paying something that's much less. And of course, as that supply and demand, that less people want your bond, they're going to pay you less. Now, if we throw the coupons back in, the regular annual payments that I had, to the £100 a year, it's the same dynamic. You've just got to take into account those extra payments you get, but fundamentally the principle is identical. If the interest rates in the economy are higher or increasing, so if the economy is starting to boom, then it looks like, for example, the Bank of England doesn't actually have to do it. If people think the Bank of England, or whether it's in America, the US Federal Reserve, are going to raise interest rates at some point because inflation is going to get away from itself, then they start wanting more from their investments because they're going to think, well, if I commit to this investment for 10 years, the interest rate that's going to be around in 5 years' time is going to be a lot higher than it is now. So I want to get a better rate of return. And the way they get a better rate of return, because the annual coupon interest payment you receive will usually be fixed, as is the amount you get back at maturity from a bond, then people will pay less for it depending on when they invest. So you can see the structure of the bond is fixed, but whoever owns it will have a different experience of that bond, won't they, when they come to it? So you might say to me, Andy, you had that bond, you paid £1,000 for it up front, you would get £100 a year as an interest payment. You're going to get back an additional £1,000 back, basically your money back at the end. After a few years, you decide that you don't want it anymore. You want your money. You need to go and buy yourself a car or whatever it is you want to do. So you say to me, Damien,
when you mention that, Damien, in terms of people basically cutting and running and thinking, yeah, now's the time. I was trying to think of a scenario where people would want to sort of cash in on their bonds. Is it generally for that reason, or are there lots of different reasons? Because I'm trying to think, if you're investing in a bond, you know what the rates are. I know economies change and everything else, but essentially you're happy at that point. Why would you ever, throughout that process, other than needing the money?
Yeah, one of them is you might need the money, so you might want to redeem it. Don't forget, people don't tend to invest in individual bonds. It's all hypothetical. They tend to buy via bond funds, but the manager's managing all this stuff, and there's lots of bonds in there. The other reason is because of the dynamic that I've explained, that you can actually have the price of the bond rise. So Conversely, if interest rates started to fall, then that means that your bond looks very attractive. If you're getting 10% a year, Andy, and I can only get 0.5% in the wider economy in a savings account or similar investments like you've got now, because you bought your bond 2 years ago, for example, let's make that up. All the new bonds being issued now are reflecting the current state of affairs, and they're not going to pay us very much because of the backdrop of the economy. So let's say they're only paying out like 1 or 2% a year. Your bond looks much more attractive to me, even though it's probably only going to run maybe for another 8 years, but it will look much more attractive. So I would say to you, Andy, do you know what? I will give you some money for your bond, and you would try and work out what it would be worth. I would give you probably more than your £1,000 that you had originally for that bond. So then what you would do is you could therefore decide, you know what, I will get my money back. I'm making numbers up here, but let's say Damien decided to give me £1,100 for the bond. I've had a couple of £100 interest payments. You may go away after only having that bond for 2 years and you've made £300, which is a 30% return, which you'd be sitting there thinking you're very happy with that, given that it was a relatively low risk investment. So what I want to do is just to give people some numbers. I'm not going to bore you with how the numbers are worked out, but let's say, for example, we'll keep it simple. 0 coupon bond. Again, it makes the mathematics easy, so don't worry about the interest payments. The principal still remains the same if they're in there. It's just the calculation becomes more complex. Let's say there was a 0 coupon bond. So there was a bond that was going to pay you £1,000 after 2 years. If the interest rate within the economy for this type of investment, do you know what I mean, was 10%, then the amount you would pay is £826 for 2 years. Because, like I said earlier, if you put £826 into a savings account that's paying you 10% a year, you did that for 2 years, you'd end up with £1,000. That makes sense. So the price of the bond with those dynamics, those characteristics, would be £826. If interest rates in the economy rose to 15%, then the price of that bond would drop to £756. Because, like I said, again, imagine that you could invest in a savings account and get 15% a year, then £756 and 14 pence invested for 2 years at 15% rate would equate to £1,000. So you can see, can't you, what I've just described there? In a world where interest rates are higher, the price is lower for the same bond, because at the end of the day, the bond is still going to pay out £1,000 after 2 years. And then conversely, if interest rates were only 5%, then the price of that bond at the same starting point with 2 years to run would be £907 if the interest rate that was paid was 5% within. That was the expected a year for that kind of investment. Does that make sense? So you can see with a 10% a year expected return that people would want, the price is £826. For 15%, it's up to £756, and for a 5% a year typical return, the price would be £907, and that is if you were going to get £1,000 in 2 years. So the point I'm trying to demonstrate to people is the way that bonds pricing works is that when interest rates start to rise, the price of bonds start to fall. So if you go back to the example that I said at the start, where I had £1,000 I put in to an investment, £100 a year interest, I get the £1,000 back at the end as well. If I decided to sell at some point, then what's going on in the economy will make a massive difference to the price I actually get. And you can even end up losing money, because let's say the price of the bonds falls because interest rates within the economy are rising, or they're anticipated to rise, then you can end up selling the bond for less money than you put in. And so this is what was quite difficult about bonds, is that the current yield idea, so you go, oh, this is the current yield on a bond, it doesn't necessarily tell you what you're going to end up with in pounds and pence, because you may sell the bond at some point in your investing journey. So what happens, there's a different metric that people calculate called the yield to maturity. I'm not going to dwell on it, but what it does, it takes into account the market price, the par value that I mentioned earlier, the coupon interest rate, and the time until maturity to give you a percentage number that's like a yield figure, which is a percentage number, an annual percentage, which allows you to compare different types of bonds with differing maturity dates. So hopefully that's made sense to people. They now understand why we've got to a point where people were thinking that the economy is starting to pick up. Inflation will pick up. We're seeing the price of things already pick up. If you go to the petrol station, you're seeing your petrol prices are going up. People are thinking that central banks will increase interest rates. So they're starting to think, well, I'm not going to pay as much for those bonds anymore now. And so the price of bonds starts to fall. And that is why the bond funds out there you will invest in will start to fall in value. And I just wanted to finish off the piece with a couple of questions that I've had from people about the idea of bonds. Like, for example, would you care about the price moves if you held the bond till maturity? Well, you wouldn't, because you're going to get those payments assuming that the entity, whether it's a government or company, is still liquid. Because one of the other factors that will determine the interest rate you get is going to be the risk you're taking. So if the entity that you're effectively loaning money to via a bond is a secure AAA government, then you're going to get a lower interest rate. Whereas if it's a sort of small startup company, then it will be much, much higher, because you're probably less likely to actually get your full money back, even the maturity amount. They might go bust. And it does also point towards the dynamics of bond prices, that as you get nearer the maturity date, again, think of things in extreme. If I was one day before the maturity date of a bond and the maturity value you would get was £1,000, all the coupon payments have been paid, why would you pay you any more than £1,000? You wouldn't, would you? So the price of a bond can be way higher than that par value. It can be much lower than that value. So our example, the price of the bond could go up to whatever, £1,200, go down to £600, all through its life cycle. It can go up and down as people then trade and buy the bond. But as you get to the point where somebody will hold it till maturity, presumably, then the price will start to come back towards that final maturity value, because then you're certain that you're going to receive that, assuming the company still exists. So did that make sense, Andy?
Yeah, no, obviously there's a lot to take in there, but the concept of interest rates moving and how that impacts bond prices, I get it now, Damien. Excellent.
But while I've got people's attention visualizing bonds and bond payments over time, it does open the door to another concept, which is duration, which I won't dwell on in this podcast. I can go into it in more detail in future if people want, but you'll see the word duration banded around in investment articles talking about what's going on in markets at the moment. But in simple terms, duration is a measure of how long it would take an investor to get their principal back. And it's a measurement in years, and it's a factor of obviously the cash flows. So let's say you have a bond that has a duration of 5 years. It's separate to its maturity. This is about cash flow and being repaid the principal. If it had a duration of 5 years, it actually measures as well the sensitivity of that bond to interest rate movement. So if a bond had a duration of 5 years, if the interest rates rose by 1%, then the bond's value would fall by 5%. So that's just a throwaway point, that if you see that number, then the higher the duration, the greater the sensitivity to movements in interest rates. So it's something just to bear in mind, a throwaway point. I can come back on and cover in more detail if people want, but it's a concept that's associated very closely with bonds. So duration measures their sensitivity to increases in interest rates.
Okay, so moving on, we're going to be talking about insurance, and there's a few insights we're going to give in this podcast. The stuff that you won't necessarily be told, even by financial advisors, certainly won't be told if you go on to comparison sites. Little tidbits, little nuggets of information. Damien, what are we starting with?
So the first one I want to talk about is if you are taking out a joint policy. So usually people might take out a joint life first death policy, which means that if you take a policy that may be me and my wife, for example, that may pay out a lump sum when one of us dies, it will pay out when the first person dies. And that might be what we want. That might be sufficient amount of money for the family to continue to avoid any financial hardship. But it is worth checking whether getting two single policies for the same amount of sum assured can be cheaper, because it can be in some instances. And the benefit of having two separate policies, and they don't have to be with the same insurer, they can be with completely different insurers, is that you will get therefore double the insurance cover for the term of your policy. So in that instance, let's say it had turned out that it would have been cheaper for my wife and I to have two separate policies for the same sum assured as the joint one would have been, the joint life first death policy, then if I died first, then the money would be paid out. But if she died as well, then another sum would be paid out. Whereas in the joint life first death policy, if I died first, then the policy would pay out that one lump sum but it would then cease. So it's worth bearing in mind. The next one I want to move on to is something that really surprised me when I looked at the numbers. So as you know, Harvey does a lot of our content now on protection, so insurance, life insurance, income protection, critical illness, and she was crunching the numbers. And one of the things that came out in an article that she wrote in the last week or so was that a level term insurance policy can be, on occasion, cheaper than a decrease in term insurance policy. Now, just to explain, a decrease in term insurance policy is a policy where the sum assured starts to fall over time. So let's say you had a mortgage that was a repayment mortgage for £200,000, and as you pay that mortgage back over 25 years, the outstanding amount starts to reduce. Well, you can take a decrease in term insurance policy that will effectively match that falling value of the outstanding mortgage, so that when you die at any point during the term of the policy, which would likely match your mortgage term, then it would clear your mortgage. And that would typically make it cheaper than just having a level term assurance for £200,000 that would pay out if you died at any point within that 25-year period. Because if you think about it, you would be receiving a lump sum towards the end where you'd almost paid off your mortgage that far exceeds the amount you need to pay off your mortgage. Now, that isn't necessarily a problem, but it's why it can be a cheaper solution to get a decrease in policy, because you're only paying for what you need. It doesn't mean that a level term insurance policy shouldn't necessarily be used to cover a mortgage, but a decrease in term insurance policy is more ideally suited. But what is interesting, if you analyse the cost difference, when you get down to really low levels of premiums, so small monthly premiums, it can be that a level policy is actually cheaper than a decrease in term insurance policy. Usually it's not. It's the other way around. And certainly as the monthly premiums are higher, let's say you may be older when you take out the policy or have medical conditions, the higher the monthly premium, the greater the likelihood that the decrease in term insurance will be significantly cheaper than the level one. But if you're operating at the lower end of premium, so probably £10 a month, then do get an advisor to check whether a level term insurance policy might be cheaper. And the reason it occurs is because at those low levels of premium, it's an incredibly competitive market around that space. And so the level term policies are really keenly priced. So it's something to bear in mind. Make sure you ask your advisors to quote on both level and decrease in term insurance so you can make a decision, because if you can get more cover for the same or less money, why wouldn't you do it? The next one I want to go on to, interestingly, whole of life policy. So a whole of life insurance policy will pay out if you die at any point. So it covers you for your whole of life. There's no term at the end, like a term insurance policy where you might have to die within, say, 10 years. And if you don't die within those 10 years, then the policy then ends, nothing is paid out, and you stop paying premiums and you just walk away. With a whole of life policy, you will be paid out something at some point. And generally speaking, whole of life policies often get a bad rap for being expensive. But again, if you analyse the cost of a whole of life policy, if you are younger, it can be cheaper to buy a whole of life policy than if you bought one later in life. So sometimes people buy them later in life to cover an inheritance tax bill, as that's the point at which they become very acutely aware of this potential inheritance tax liability, for example. But had they bought it, say, 20 years earlier, despite the fact they would have paid premiums for far, far longer, it could still work out cheaper. So a whole of life policy can provide value if you buy it when you are younger. Now, there's more nuance to it, which we'll link to in an article that Harvey wrote on the topic. The next one I want to talk about is critical illness cover. Now, critical illness cover is where it pays out on you being diagnosed with one of the listed critical illnesses within a policy. Now, that can be forms of cancer, for example. You don't have to actually die, you just have to be diagnosed. And that's why it's a policy that can be expensive, because it's more likely to pay out than a life insurance policy, depending on your age. So what I wanted to point out on this, it is an expensive form of cover, but obviously if you can afford it, it can be incredibly useful. And it's well worth going back and listening to the episode we did with Emma Thompson on the benefits of having critical illness, because when she was unfortunately diagnosed with breast cancer, Andy will link to it in the show notes. It's a very powerful episode that we received a lot of good feedback on. But what will happen if you apply for life insurance? You may, for example, have an advisor, or you may choose to add critical illness alongside that policy. So let's say, for example, you took out a £200,000 policy with critical illness attached to it. You may not even have to have the full £200,000. You may decide to have a £100,000 critical illness attached to your life insurance policy. Well, there is something that's called accelerated critical illness cover, which is what most critical illness that's sold alongside life insurance actually is. And what that means is that if you were to be diagnosed with one of the listed critical illnesses, the policy would pay out, which is obviously great. You'd get your £100,000 in my example. But the problem is the accelerated terminology means that it pays out the critical illness cover, but that's deducted from the potential life insurance cover that you've got. So then if you were to subsequently die, you would only actually get paid out £100,000 worth of life cover. The totality of the policy is the £200,000. You can buy critical illness cover in addition to life insurance. So that, yes, that will be more expensive. But the reason I mention it is because a lot of people don't make the distinction. And I think people probably end up buying a policy that's got, say, critical illness attached, and they don't realize that it's this accelerated version. Check your policy details and you will see it in there. And I just want people to realize there's nothing wrong with it, but that they understand the implications. Because if, for example, you really still needed £200,000 worth of life cover for some reason after you were diagnosed with a critical illness and you had that 100,000 payout, then you probably won't get it, because the chances are if you then had to go and apply for another £100,000 worth of life cover to replace the amount that you will no longer be paid, then you may be declined by an insurance company because of the critical illness you've had, or it'll be very, very expensive. So people just need to be very aware of that. There's one other that I want to talk about, and it's about index linking. And it's such a big issue. I'm going to talk about it next week, Andy. And it's about inflation linking your policy. It's what they call index linking. It's actually something that I think everybody needs to listen to, because there's a lot of profiteering and that's going on with policies that have this link to it. So we're going to give people some insight and guidance as to whether they should even do it. And Andy, you've got two more just to wrap up on this one.
Yeah, okay. So the first piece I wanted to highlight is in regard to life insurance. And it's really thinking about the length of the cover that you need. Now, one fairly good tip is to think about how long you might need the cover, and actually potentially taking the cover for longer than you need. Now, that might seem counterintuitive because life insurance is more expensive the longer you take it. However, life insurance is even more expensive the later you take it in life. So if you think about, say, a mortgage, when you take out a mortgage, let's say it's 25 years, there are many times when people might decide during that process to remortgage, whether to remortgage for more or to remortgage over a longer term. Now, the problem with life insurance is if you try and change your insurance or increase your insurance in terms of adding more money to it or taking it over a longer term, if you do that later in life, that does become relatively expensive. So it may be worth thinking about, especially while you're younger, taking life insurance for a longer period of time, because there isn't really much difference in price when you're young. However, you do it later in life and it becomes quite expensive. So it's just something to think about. Think about how long the cover is needed for, and think about whether you want to increase the length of that cover and future-proof your insurance for later life.
And the thing to add to that, Andy, is that there's anecdotal evidence of some life insurance advisors who aren't able to provide future-proofed recommendations due to their own internal compliance procedures, because the emphasis is often on protecting the need that you have at this point, not necessarily selling them something that could future-proof and potentially happen. So if you are getting advice, then if you want to do that, then be bold and make that clear, because it may be something you have to look into yourself. And your last point, Andy, is
income protection. So just to briefly explain what income protection is, we've done income protection before on the podcast. It is a policy that you purchase and you pay for yourself. Some people are lucky and actually they get it provided as a benefit by their employers, but essentially you will pay a monthly premium and it will guarantee to pay out in the event that you are unable to do your job due to accident or sickness. Now, unfortunately, statutory sick pay is relatively low, and in most people's circumstances, it won't cover your monthly bills, your mortgage and everything else. Now, that policy is priced on various factors. The main elements are your age and the type of job you do. But another key factor of the price of that policy is when the policy begins to start paying out. So if you're lucky and your employer pays you sick pay, let's say 13 weeks, 6 months, then you wouldn't need a policy to start paying out your income, your replacement income in the event that you can't work until the 3 months or the 6 months have passed. Now, the longer you can wait for the money to start paying out, the cheaper that policy is. Now, some people aren't lucky enough to have an employer that will pay them sick pay for 3 months, 6 months, 12 months, but there's an emphasis lately, and we've all been talking about building emergency funds. So if you are someone that's been building an emergency fund and you're lucky enough to have some money put aside that will serve you for 3, 6 or 12 months in the event that you can't work, then you should consider looking at buying one if you haven't got one already that has a longer deferred period. Again, the deferred period is the amount of time that the policy will wait until it starts paying out. It makes a massive difference to the amount you pay on your policies. So it's just one to consider. If you've got some savings, don't take out a policy that will kick in and start paying out after a week or 4 weeks, because they are relatively expensive.
Okay, so I'm conscious of the time. So the last piece on the podcast this week is about faking it until you make it. And it's something that is, I think, very relevant at the moment, where we're all probably more aware of mental health. And it was something that was very popular back in the 80s, about faking it until you make it. So you basically be the person you want to be. You act like the job that you want. You dress like the person you want to be. And really, you're just portraying, you're acting, and then eventually you will be the thing that you want to be. And it was a big movement. But unfortunately, that is terrible for mental health, because you're actually just trying to keep up with the Joneses. But the other point I want to talk about is financially, it's terrible. And the concept of faking it till you make it is very relevant in finances. We all do it. And usually there is something in particular that we all like and will spend money on or show off. I mean, it could be a lot of people, it's cars, a lot of people, it's clothes and how they appear. It could be beauty products, whatever it is. There'd be something where people are trying to portray an image of themselves, maybe even holidays, so they can appear successful. Now, that behavior, which we all do to lesser degrees, some of us will have a particular thing that we will spend the money on that we want to show off. Like I say, cars is a very popular one. How many people have I known that live in my street, which is full of terrace houses, having cars that are worth 60, 70,000 pounds, which just doesn't really make sense. Now, each to their own, but there's a danger you become a slave to that. So that's the point that I want to make. And the problem becomes that if you are continually trying to fake it until you make it, when it comes to finances, you might not ever actually make it, because you get yourself into a hamster wheel of debt in particular. So this is very relevant to debt. You'll never be able to put money aside to invest or for a rainy day. And I think that's become particularly obvious to lots of us as a result of the pandemic, where people have lost jobs or businesses have struggled, that we've all had to look inwardly on our own finances. And there's a famous quote that's attributed to all sorts of people, from Will Smith to Dave Ramsey to Fight Club, which is, we buy things we don't need with money we don't have to impress people we don't like. And so that,
I like that. I like it. Well, I don't like it because it's awful what it's saying, but I get it and it makes sense. Wow.
But that is something I want people to take away from today's episode, is that have a look at your own finances, where you're perhaps starting to try and fake it to portray something to other people as success. And interestingly, again, this sometimes links quite nicely to elements of what we hear and see in the financial independence movement. A lot of those people do step off the consumer treadmill and aren't a slave to advertising. So if we learn something today, if it's not about bonds, if it's not about insurance, it's about looking at whether we are trying to portray something else with debt in particular. Because if you are, whether it's why buy a new car, buy a nearly new car where you save on all the money that from depreciation, all those sorts of things, it can be quite a shortcut to improving your financial situation. So that is it for this week, Andy. I would like to say, as ever, please do leave a review. We've had a couple of reviews this week, which we will aim to read out perhaps next week. But do send in more reviews, because they are incredibly positive. And one of them actually mentioned the rest of the team and members of the team by name, which you don't see but that was a huge buzz for those people when they received that review, particularly as they're not used to coming on a podcast to discuss money. So that was really good. So thank you to those people who sent those in.
Excellent stuff. So if you want to contact Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. And don't forget, as always, we've got the Facebook group. Go over there if you haven't already and join a growing community. It's facebook.com/groups/money to the masses. And that's it. We're done for this week, Damien. Until next time.
Until next time.